To use this approach, we need debt ratings. These are issued by companies such as Moody's, Standard & Poor's and Fitch. Analysts will then take those debt ratings and determine the cost of debt for companies with each of those ratings. For example, an analyst might determine that firms with a AAA rating have a cost of debt on average of 3%, AA 3.2%, A 3.4%, and so on. There is one problem with this approach. The cost of debt of 3% implies a certain risk premium over and above the risk-free rate. Suppose the risk-free rate is 2.5% when these costs of debt are issued. If it then changes, for example, if it falls to 2%, all of these costs of debt would have to be adjusted accordingly. To avoid this problem, instead of issuing outright interest rates, as we saw a moment ago, they issue credit spreads, which is the risk premium over and above the risk-free rate of return that is implied by a firm's cost of debt. There is one further problem. Because these credit spreads are expressed as percentages, they could be confused with outright costs of debt. So instead, analysts usually issue credit spreads in terms of basis points, where a basis point is 1/100th of a percent. There's one final issue we need to deal with. Because interest payments are tax deductible, the effective or after-tax cost of debt is not the same as the investor's required rate of return. The Australian Taxation Office allows firms to reduce their taxable income by the cost of debt or interest payments that have been made. This is the formula to calculate the after-tax cost of debt, where RD is the before-tax cost of debt and TC is the corporate tax rate. For example, if the tax rate was 25%, the after-tax cost of debt would be 75% of the before-tax cost of debt.